Okay, guys, let's take a look here at exercise 813. Entries for bad debt expense under the direct write-off and the allowance methods. So we've got a couple different things here, a couple of transactions and things that are taking place. And remember, with the direct write-off method, it's acceptable under generally accepted accounting principles only if the amount of bad debt expense is going to be immaterial or not significant enough to change the overall picture of the company's financial position. Okay, so if it's an insignificant amount, it's okay to use the direct write-off method. However, if it is significant, if it is material, if the company must follow generally accepted accounting principles, if it's a publicly traded company, for example, then they're going to have to use the allowance methods. And there's more than one different way to calculate the bad debt expense and allowance using this allowance method. So let's take a look here. A couple things took place, and remember, the first approach we're gonna take here is the direct write-off method. Then we'll come back and work it using the allowance method. So remember, with the direct write-off method, we wait until the amount is deemed to be uncollectible, and at that point we write it off. So perhaps we've sent them a notice that they're past due, they need to pay us. It comes back, return to sender. We try calling them, their funds disconnected, or maybe we swing by their place of business and it's boarded up and it looks like a ghost town, nobody's there. Okay, so or for whatever reason we deem that it's uncollectible, at that point we are going to record the expense and eliminate the accounts receivable from our books. It doesn't make sense to have an accounts receivable on our books if we know that it's worthless, right? That would be misleading. So we need to remove that asset and we need to record the expense. So on January 27th, we wrote off the account of C. Knoll, $6,000. On the 17th of February, we're going to receive $1,000 as a partial payment. Joni Lester owes us $3,000, so that means there's $2,000 difference between that. She owes us $3,000 and she paid us $1,000. And for whatever reason, we determined that remaining $2,000 we're not going to be able to collect that, so that's uncollectible. Then on the 3rd of March here, we received $6,000 from C. Knoll, which had been written off January 27th. So we wrote this off, and then surprise, surprise, not something that would typically happen, but he came back and ended up paying us. Maybe he decided he wanted to uphold his side of the deal. He paid us. We're going to learn how to account for that. On the 31st of December, we're going to write off all these different accounts. Okay, now remember, when we make these entries, we need to specify which account receivable it is. As the book has indicated, we have a subsidiary ledger. We have for each one of these, we have a different account receivable record so that we know exactly who owes us what. It's not sufficient to say, hey, somebody, collectively we are owed $48,000 in accounts receivables. We need to know exactly who owes us what and how much so that we can properly collect it, okay? All of those added together would be what would appear on the balance sheet as accounts receivable. Collectively, all of the accounts receivables from the various different people that owe us money, okay? And then here at the end it says, if necessary, record the year-end adjusting entry for uncollectible accounts. Well, we know under the direct write-off method that we don't need to make an entry at this point because we make one each time we learn that an amount is uncollectible. Okay, so this is what the solutions look like here. And so for the first one here, C. Knoll, we learned that he's not going to pay us. At this point in time, now that we know that this is not collectible, we have to eliminate this accounts receivable. We need to get rid of this. It needs to be gone out of our books. We don't want to mislead a financial statement user because this is not worth anything, right? We deem that it's not going to be collectible. So we do that, and at the same time, we need to record an expense. We're reducing this asset, and in order to keep the accounting equation in balance, we're going to reduce equity through the increase of an expense. Bad debt expense. On the 17th here, we received $1,000 in cash. That's one thing that took place. We mentioned here that we're completely removing this accounts receivable related to Joni Lester from our accounting records, and the difference is $2,000. That's the amount that's the bad debt expense. So we need to go on and debit that. These two equal $3,000. This is a compound entry here. The two debits equal the one credit. Now you'll notice here on the third, Mr. Knoll here decided to go on and pay us. We were surprised that after we'd written it off, he came back and actually went ahead and paid it. But what we do here, the first entry is to reinstate this accounts receivable. It's a flip-flop of this. It's like a reversal of this entry here, right? So we take this, we flip the debit and the credit. That essentially eliminated this entry we made on the 27th. And then the next step is to record the entry to show the receipt of cash. And this is the same entry we would make if we just received $6,000 from any person or company that owed us money. We would debit cash by $6,000 and we would credit accounts receivable by $6,000. And lastly here we have this all of these other various accounts receivable. Maybe at the very end of the year we sat down and looked through and tried to analyze the likelihood of us collecting these, and these 5 people here we determined were not going to pay us, therefore we needed to remove their accounts receivables. We do that with a credit to this asset, to these assets I should say, and we have our debit to bad debt expense. Like I mentioned before, there's no entry that's required at the very end of the accounting period. There will be under the allowance methods, however. Okay, so take a look at this now. We're going to work the same problem, except for now, first off, we use the direct write-off method. Now we're going to use the allowance methods. And the only thing that's different here is that it says that now let's assume we're using the allowance method, and we've chosen to use the percent of credit sales. This is the income statement approach here, method of estimating the uncollectible accounts or the bad debt expense based on past history and industry averages. 1 3/4% of credit sales are expected to be uncollectible, and we recorded 1.6 million of credit sales during 2012. So remember, with the allowance method, basically what we do at the end of the accounting period, we're going to make an estimate of how much bad debt expense we think we would have to offset the revenues from that year. The allowance method better upholds the matching principle because we're matching these bad debt expenses to the revenues that those expenses are tied to, right? And so everything's going to be pretty much the same as we work through this problem. You're going to notice that essentially wherever we saw the bad debt expense account in the previous example, we're going to substitute that with the allowance for doubtful accounts account when we use the allowance method. And then the other major difference is at the end of the accounting period we need to go on and make that estimate. Okay, and this is the method that you must use if your bad debt expenses are material. Okay, one second here. Let's go take a look at the solution. Okay, so you can see here, same situation. This guy, Mr. Knoll, did not pay us. We deemed that it was uncollectible at this point. Instead of debiting bad debt expense, instead we are debiting allowance for doubtful accounts. Allowance for doubtful accounts is a contra asset account. Remember, accounts receivable is an asset account, and this allowance for doubtful accounts is a contra asset account. So if an asset is increased with a debit, that means that allowance for doubtful accounts is increased with a credit. And if we look down here at the bottom, the last entry that we're going to make is to fill this bucket up, this allowance for doubtful accounts. We're filling this up. We're recording the bad debt expense for the year, and we're filling this bucket up. And throughout the next year, whenever an amount becomes uncollectible, we reduce it with a debit. Here's a debit. Here's a debit. Okay, here's another debit. So every time we determine that an amount is uncollectible, well, heck, we've already written off the expense in the year that it took place, because keep in mind, with the direct write-off method, or even with this method, it might be a year that goes by before an amount actually is determined to be uncollectible. So with the allowance method, we need to record the expense, the bad debt expense associated with those sales in the period that it took place, and then later down the road when it actually becomes uncollectible, we just offset we reduce the allowance for doubtful accounts, and then we specifically remove the accounts receivable. Now, when we make this estimate down here, we're increasing this contra asset account, and we can't credit an accounts receivable. For example, here we knew these specific accounts were uncollectible, but at the point in time that we estimate this, we have no idea who's actually not going to pay us. And as we learn that, we make these entries here, and we specifically eliminate these accounts that are going to be uncollectible. And at the same time we do that, we're going to reduce this contra asset account with a debit. Did I confuse you yet? I hope not. Let's take a look here on the 17th. Remember, we received a $1,000 payment. The person owed us $3,000. So, and like I said before, we would have seen bad debt expense here under the direct write-off method. That would have also been used for this account here. But under the allowance method, we substitute that with the account allowance for doubtful accounts. So here we received the cash. We are reducing the bucket here of this allowance for doubtful accounts. And the accounts receivable here, that has to go away. I keep mentioning the bucket here. I keep saying we fill the allowance for doubtful accounts bucket. And then maybe this little illustration here, that's a snippet from a PowerPoint presentation, maybe this will help you understand it. So at the end of the accounting period, when we make that adjusting entry, a debit to bad debt expense and a credit to allowance for doubtful accounts, we fill this thing up. And then when we specifically write off the accounts receivable with a debit, that's going to empty it. Okay. So like I said, the two methods are very similar. Here, same thing, CNOL surprises us and comes back and pays us. The first step is to reverse the entry we made on January 27th up here. Second step is to record the receipt of cash and to go on and get rid of this accounts receivable. The allowance for doubtful accounts, here this is going to be debited to show that all of these added together equal 11,100, and we're removing each of these individual accounts receivables, and the offset once again is going to be to reduce the allowance for doubtful accounts. And we're going to fill the bucket up. So throughout the year we're emptying, we're taking more and more dollars out of the allowance for doubtful accounts bucket, and at the end of the year, when we estimate the amount of bad debt expense for the current year, we are essentially filling the bucket back up for the upcoming year. So here we had 1.6 million, and 1 3/4% of that we deemed to be uncollectible. So 0.00175 times 1.6 million is going to give us $28,000. So we have a bad debt expense of $28,000, and our credit goes to allowance for doubtful accounts, and this fills the bucket up. Now remember, if we were using the method where we age the accounts receivables, we have to analyze and look at how much of a balance we have left in the allowance for doubtful accounts account before we make the adjusting entry. That's the balance sheet approach. This is the income statement approach, and we're not concerned so much with what the balance is in that account. We just look at the sales and take a percentage of the sales as being uncollectible. The focus here is more on having a more accurate income statement.